So, hello and welcome to this week's instalment of Nucleus Investment Insights. And we've entitled today's one, Bad News is Boom News, or, the rise and rise of equities. So we're going to be looking at the elevated prices of equities around the world and throwing together some thoughts on how we got there and what to do next. I'm joined, as always, by our Chief Strategist, David Llewellyn Smith. G'day, David.
G'day, Tim.
And our Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim.
Hello to you. Okay, so let's roll into the agenda. So, valuations. So we'll kick off with some valuations. We'll then look at growth. We'll then have a look at some macro drivers we're keeping an eye on, and then, of course, roll into the risks and some of the areas that we're looking at that may exacerbate or alleviate the position that we find ourselves in now vis-a-vis stock valuations. So let's jump into our first one for the day, which is high valuations. And we've got a chart here, and for those that are listening in on the podcast, as always, we will be providing the chart pack in a link in the show notes. But who'd like to kick us off with high valuations? Damien.
Yeah, I've only got a couple of charts in here, mainly because when it comes to looking at valuations, there's no one real measure that sort of encompasses everything. So what we like to do is look at a whole different range of measures. And rather than making this sort of a 40-page slide deck, I thought I'd just run through the real quick ones first. So the key one is just looking at 12-month forward price to earnings, which shows are pretty similar to most other metrics. You get a few differences between regions and sectors depending upon what you're looking at. But by and large, we're looking at valuations on a global basis that are expensive, but not excessively so. So they're below what we've seen post the sort of in 2014 and 2017. We saw much higher valuations. So we're sort of sitting around about that 16 times earnings on the on the world. Australia, though, is certainly on the more expensive side, so it's sitting much closer to, it's sort of at 17 times earnings, which is pretty close to its peaks over the last few years. So Australia is certainly sitting a fair bit higher than what we're seeing in terms of the rest of the world. A lot of that rest of the world, though, comes down to the US versus everywhere else. And so if you jump to the next slide, I've just got a slide just breaking up the relative valuation. So what's the premium or discount of each different market relative to the world index. And so on this basis, you can see that the US just keeps being at that sort of 10 to 15% more expensive than the world, and Europe just keeps drifting away. So from almost parity to the world in sort of the 2014s and 15s, and then just sliding down as things continue to stagnate in Europe. And so I guess it's a question of trying to work out where you're actually getting the growth from. And so this chart is actually a relatively good example of, it fits relatively well with where you're seeing the earnings growth. So you've seen the earnings growth coming from the US, and so it sits on a much higher multiple than the rest of the world. You've seen not a lot of earnings growth at all in Europe, and so that's been that's reflected in the price and the premium that you're paying. Australia is a little bit of an anomaly. We're not seeing much earnings growth at all in Australia, although you do get some. We've seen the big iron ore stocks have made a bit of a difference in terms of the iron ore price. So a little bit from there, but by and large, Australian earnings have actually been very weak. Yep. And especially when you dig into the individual sectors, so its pricing is more of an anomaly. So I guess we're running at growth much closer to Europe's, but we're sitting on a price to earnings multiple much closer to the US.
And do you think so? We can see here that there was sort of an inflection point, sort of mid July of 2017, which sort of roughly coincides with the turning point of the Aussie housing market. Talking about Australia here, do you think that there may have been a pivot into equities to sort of help provide a little bit of a boost into the share market? So there's liquidity out there. It's not going into being funneled into swapping houses with each other. Is it then people are going, okay, I've got to put it somewhere. Am I sticking it in debt?
Yeah, I mean, you get
equity rather.
You get a bit of argument about where the marginal buyer is for the Aussie market. From what I've seen, I don't think the individual Australian investor makes as much of a difference as global investors.
Right. Okay.
Drifting in and out. So I think when the Australian market is sort of 2% of the global market index. Mm-hmm. So a large, or a international fund managers deciding, okay, I'm going to allocate an extra 0.1 or 0.2% to my Australian holding, is in my mind such a greater impact on the effect of the valuation for the Australian stocks than whether than anything that happens sort of domestically within Australia.
Right. Okay.
And so and Australia is very much looked upon as a bit of a turbocharged way to play world growth, because when world growth's going well, Australia's got lots of resources, and that tends to go well, and then vice versa. And you also see the Aussie dollar rise, so you sort of get a double whammy if you invest in Australia. You get the world growth exposure, and you get a currency world growth exposure as well. And so so that's the way I tend to think that. That's a bigger effect on valuations in Australia than individuals. Having said that, once you dig into actual individual shares within Australia, you find that the Australian market is actually even more expensive than it looks on this measure, because Australia's got so much resources and banks.
Yep.
And resources and banks traditionally trade at very low multiples. So if you line up sector by sector and you start looking and saying, well, let me see Australian banks versus global banks. Let me see Australian resources versus global resources, and they're not that much. Australian banks look expensive, and Australian resources are sort of not. They're a large part of the world, so they're sort of similar priced. Then you start going through the other sectors, and you just sector by sector, Australian market is more expensive than global markets, and in most cases more expensive than the US markets as well. So the headline figures hide how expensive the Australian market is.
Yep. Okay. Just one more question, actually, and for those listening in, feel free to drop some questions in on the live chat there. It was just a quick one that popped in my mind. So we've got a falling currency. So part of what you were saying there, that impetus to jump into Australia from overseas, and overseas being a key driver, as you mentioned before. So is the high dividends and the payout ratios perhaps then enticing to a foreign investor, perhaps even if they could hedge out some of the currency risk, or would that be an impetus, do you think, for a foreign investment house to jump in?
For some, yes. I mean, the argument comes back, and I've run a few things on this in the past, just looking at the payout ratios you see from Australian companies versus international. So if you look at Australian companies, just pay out a much larger proportion of their earnings, and most of that is due to franking credits. So they're just trying to get. Australian companies are generally trying to get their franking credits off their books and out to shareholders, because it's of no use to the company and it is useful to the shareholders.
Sure.
In contrast, international companies don't have that, so they often have much lower payout ratios, but they then pay out much higher levels of. They then have higher levels of buybacks.
Yep.
So the net effect is you're getting the same result. You're either getting it's basically people looking for tax efficiencies. In Australia, it's like, well, it's tax efficient to get rid of these franking credits for my shareholders. In global things, it's tax efficient to do buybacks to get the share price up, and not have to worry about the income side. They can just get it all on the capital side. And so so international shareholders as well, investing in Australian companies, generally don't get the franking credits, and so for them the franking credits is lost exactly. And so so I guess what I'm saying is the answer's superficially. You might find some people who do it superficially. I think as from an institutional perspective, though, I don't think that they're too concerned whether they get the return from income or from capital returns. And so if they're going to get higher they'd probably prefer to get capital returns. So it's almost a negative for the Australian. Yeah. Okay.
Stocks. All right. Yeah. No, great answer. Anything to throw in on this one, Dave? Okay. Just one last final one. Just sort of peering into Europe. So we've had quantitative easing, or the general growth of the government balance sheets, and in the US could help sort of support some of the rise we've seen there. Why are we not seeing it in Europe, where the ECB's been going nuts with the printing machine as well?
Certainly, it's been. I mean, the PEs have been rising. The issue is this is a relative chart, so everything's going up. Just the European PEs aren't going up as fast as what the US and the Australian ones have been doing.
Second derivative. Okay.
So this is
You've also had quantitative tightening going on in both the US and Europe
recently. Yep.
Over the last 12 months. Yeah, so I mean, those liquidity flows are considered to have some impact on the valuations story.
Okay.
But we'll move a little bit more into the effects on their valuation and the sort of underlying drivers. Once so just sort of putting the picture out there that most markets are expensive, and the US and Australia in particular are more expensive than some of the other markets. The other one is the earnings growth. So earnings growth is always an interesting one about how you look at this. We've got a chart up just sort of showing the progression of growth over time. And what you tend to find, and these are analyst forecasts, what you tend to find is analysts make forecasts about what a company's going to earn, and then over time those forecasts generally tend to fall. So they come out with an optimistic view of how things are going to look in next year and the year after, and then as time goes on, those get sort of ratcheted down, and they end up being whatever the final numbers actually are.
Mm-hmm.
And so what this chart at the moment is showing is that 2018 was the opposite, where everyone had this view that the earnings would be about 10%, and that tends to be what later year earnings, everyone sort of guesses about 10%.
Right.
And then as time went on, though, that all of a sudden rocketed and sort of ended up closer to 25%. And that's because of the tax cuts we saw in the US. So,
right, yep.
So a little bit of that was actual growth. Most of it was tax cuts. And arguably the growth you saw might have been second derivative from tax cuts as well.
Okay.
So then we look at the 2019 numbers. Again, started at that sort of roughly 10%, and then we've seen some pretty sharp downgrades. We're about halfway through the year now. US is in its reporting season at the moment, and it's getting pretty close to zero in terms of the expectations for the full year of 2019. These are US companies, and it's generally speaking, whatever's happening in the US, it's worse in Europe and Australia.
Okay.
2020, you haven't seen much change yet. They're basically forecasting about a 10% return. Having said that, though, if you flick to the next chart, the issue for earnings is not so much, it's important as to whether analysts are upgrading or downgrading, but the bigger issue is the actual absolute number. Is that changing? And what happens is so most people either, when they're looking at analyst forecasts, will generally try and use a constant horizon. So you can look at 2019, or you can look at 2020 or 2021, or you can just say, well, let me just use a 12-month forward horizon, and I'm just going to keep rolling that forward. So every month I just take one less month of 2019 and add one more month of 2020.
Okay, sure, yep.
And this is the one that really drives valuations more so than the prior chart, because this one shows that earnings have actually been rising. We saw earnings fall at the end of 2018, and so some quite negative. So the actual 12-month forward number was falling, and whereas now, even though both the 2019 and the 2020 forecasts are falling, what's happening is because you're getting a little bit more of 2020 and a little bit less of 2019, and 2020 is higher than 2019, that number is still rising. So it's when you get more concerned is when the rate of fall in those numbers turns it negative, as it did sort of the end of 2018.
Sure. Okay.
So at the moment, I'd call it holding, I suppose, not really rising, and I do think the 2020 numbers haven't really been looked at properly by analysts. You saw on the prior chart there was this general trend of they sort of hold around that 10%, and then all of a sudden they rocket downwards once that number becomes the next focus. So what tends to happen is right now everyone's focused on what's happening for 2019, and then 2019 becomes actual, and everyone goes, oh, let me go and have a look at 2020 now.
Yeah,
and
okay.
Oh, gee, those numbers look a bit high. We need to pull those back, and then
Right.
that's where you get the fall in 2020 numbers. So so from an earnings perspective, it's certainly not as negative as it was 6 months ago. So there's some support in terms of the earnings, but it's the real question will be as people start to focus on those later years, and we get through this reporting season and see where these numbers are going. But our expectation is sort of holding is what your best bet.
Yep.
And it's falling in some markets like Australia or Europe.
Okay.
Same one.
Sure thing. All right. So we'll roll across into equity risk premium. We might just need to start with a little bit of an explain 101 on that term.
Yeah, sure. I think you could spend a long time explaining this one. I think that the net effect is when someone wants to value a share, you're effectively valuing it as a stream of cash flows of some sort.
Yep.
So whether you want to do the dividends or whether you go into some of the underlying cash flows to work out what the right number is. and then you're discounting that back. So you're saying, okay, well, if I can get $4 a year from this stock, then I think that means that I can add that up, and I can say, well, I'm going to turn that into a $20 share price, or a $40 share price, or whatever it is. And what you decide, how that multiple expands, or is based on what we call the risk premium. And that's largely driven by bonds. There's an individual component for each stock, but then there's an overall component, which is the bond or what the bond markets, and then there's an additional part, which is how much I'm paying for risk. So I can buy a bond and get a much lower return. There's this extra slice. I'm going to say, well, if I'm not going to buy bonds, I'm going to buy stocks.
Yep.
How much am I paying for that extra risk? And then the final part is the individual stock part. And this one's showing the overall world equity risk premium and how that's changed.
Okay.
Yeah. So basically, the key to understanding it is the lower bond yields go, the lower the risk-free rate is, then the higher the risk premium.
If prices don't change.
Yeah. And so basically, it's a kind of an inverse correlation to inflation.
Okay.
And this is the kind of the key macro driver to the high valuations that we're seeing at the moment, as well as the last sort of 3 months of rally that we've seen in the US globally, and especially in Australia, as bond yields have really been taking a flogging. And that's the sort of the key actually to the title of the presentation, which is, the more bad news you get, the more the market worries about growth prospects up to a point, the point at which earnings are genuinely going to fall. Then the higher the stocks can go, because bonds are bid as inflation falls away.
And actually put that another way, I mean, I think rather than focusing too much on this graph, if you sort of talk more about the when somebody buys a stock, you're basically saying, well, I can go to a government and get a 10-year government bond for 5%, for example.
Yep. So obviously risk-free rate.
Obviously, no government at the moment. No, but no
AAA government, perhaps. Anyway.
20 years ago, you could find plenty of them. And so then when you say, okay, well, so if I'm going to buy stocks, I'm going to have to get better than 5% return. I'm going to need and I'll put a risk premium on that and work out what I'm going to get.
Yep.
And so let's say you only need 3 or 4% more, and then you're happy to invest in stocks. Well, if that bond yield goes from 5% to -1, which is where it's sort of sitting for a number of countries and pretty close to zero for most others.
Yep.
Then all of a sudden, what you need to earn on stocks you don't need to earn as a 9% return on stocks anymore. You only need to earn a 5% return on stocks to make it worthwhile. And so that justifies why you can keep bidding these up. And so that's one way of looking at it, whether it's the right way or not. There's sort of lots of argument over that. But we'll probably jump into the risks actually.
Yeah, let's have a look at the risks. So, Dave, kick us off with the trade war.
Sure. So, obviously there's been some reasonable news on the trade war in the last few weeks since the G20, with re-engagement of negotiations. That said, the Australian dollar is a pretty good proxy for the way the trade war has run, and the rebound there has been pretty muted. And even the good news flow that we've seen in the last week or two has done very little for the Australian dollar. So markets become quite sceptical about, where the trade war rapprochement is going. We kind of think that they might get to a point with the trade war where there's some sort of announcement that can be made for both dictators. That said, it could only possibly be...
I suspect one side's a want to be dictator.
Yeah.
I'd say it's probably not quite there yet.
Yeah, quotation marks there. That'd be more... We think it'd largely be a PR exercise anyway. And so the trade war is likely, to continue for the many reasons that we've discussed previously. And so therefore it's an ongoing headwind, especially for Chinese growth.
Yeah, so actually, and just to put that into context, some of those risks for newer listeners. So I guess the way we look at the trade war is that there have been some structural changes now that if in terms of the way Chinese companies are addressed in terms of the supply chain, so that US companies or are basically being strongly encouraged to move their supply chains away from China. So 3 or 4 years ago, it would be perfectly reasonable for a US company to turn around and think, well, I'm spending too much money on all my systems. I'm going to move everything into China and then just import all the products. Whereas that's gone under quite a significant structural change in terms of the risks, and some of these bans on different companies and on and off and all that type of stuff has, regardless of whether the bans are still in place, they've had the effect of scaring the US corporate boardroom into moving their supply chain and diversifying their supply chain away from China. So that's sort of one big negative. The second part is that technologically, there's been lots of leaks about spy chips and hacking and all these other things in terms of China. And so the issue there is there's been a certain amount of trust that was I guess implicit there 4 or 5 years ago, where people would again outsource things to China without even thinking too much about the process. Whereas now there's a big focus on, well, if this is sensitive information, you're worried about it, and you think it might, that industrial espionage might happen, then don't send it to China. Do it elsewhere. And so we think that's there's been a relatively marked structural change that, regardless of whether there's an agreement to, okay, let's go back to the way things were before, you can't put that genie back in the bottle. It's that's gone now.
And we're seeing that trickle down through even basic manufacturing. Last night we saw, well, previously we've seen the bike manufacturer Giant pull out a lot of stuff out of China, and last night we saw Hasbro, which is just basic toy making. This is really kind of low rent stuff.
They get about a quarter of my income at the moment with 2 young kids.
Yes, that's right. Well, they're shifting to Vietnam and India, a lot of their production. There's one other dimension to that, I think, which is that China's response to being called out on a lot of this stuff has actually been a bit unhinged, and they've responded very aggressively and angrily, to the point where they're arresting Westerners and what have you, and embarking on hostage diplomacy and pretty wacky stuff. And you've got obviously Hong Kong intensifying that, and so there's actually a personal dimension here for Western executives. Do I really want to have to fly to China and investigate the supply chain on a frequent basis when you have so much volatility in the politics?
Yeah, that makes sense.
So especially, take Canadians. There's been a number of Canadians arrested, and so if you're a Canadian executive and your government's arrested, a senior Huawei exec, and that's still uncertain as to what's going to happen there. Do you really want to fly to China and worry that something your government decides to do something, and next thing you know you're
eating Chinese prison dumplings?
So that's why we see this as structural. So much harm has been done to sort of the peaceful rise of China rhetoric that it's kind of an unstoppable trend now for a lot of this offshoring to shift away from China. So I mean, that's a risk in terms of global growth. We've already seen it weigh very heavily on the industrial output of China, which is filtered directly through to Europe. And Europe's got, basically is struggling to keep its head out of recession. At the moment, its industrial economy is definitely in recession. Job losses are starting to flow out of that, and will we see services follow? Probably. So that brings us to risk number 2, which is, we have this sort of failing Europe coming out of China, and a hard Brexit approaching. We don't know if it's actually going to go, but it is embedded in the current negotiations that if they can't, if the new Prime Minister of the UK, Bojo, can't renegotiate something by October 31, Britain automatically rolls out of the EU. And, can Parliament intervene? Maybe. But at the moment, there is a real prospect of a hard Brexit. Politically, it's probably in his best interests to try and do it, simply because the Tory party's being eaten by Nigel Farage, and the election's still a few years away, but they really need to clean this up. If they can take a hard Brexit, take the economic pain, and try and rebound into the next election, I would say. So those two combine, then to create the possibility. Well, the three, I guess you can look at China's growth there too, out of the trade war, obviously as well. That's more of a structural story around its rising debt. The other feature of that, of course, is it's responded to the downshift in its industrial economy by boosting construction again, especially in empty and useless apartments, rather than infrastructure, which would be a little more useful. So those three things can actually come together in a risk case that can see global earnings actually take a serious hit sometime in the next kind of 12 months. And when you consider the age and sort of greying of the business cycle, it's the longest business cycle more or less in US history already. That makes us quite cautious about the valuations and what the prospects of earnings taking a material hit enough for it to overwhelm any kind of lower bond yields and equity risk premium is material.
And just on that, so effectively, and this sort of goes back to that sort of commonly trotted out line, external shock. It's everything's great until there's an external shock. So this would sit in that wheelhouse.
Yes.
Yeah.
Absolutely.
And so I guess part of the coming back to putting that into context. So it's not bad to buy stuff when it's expensive if you can see the growth coming through, and that the growth pretty quickly makes it not expensive. And then that was the 2018 example of that was the Trump tax cuts. Was that markets were relatively expensive at that point, but you could very easily see, okay, I can see where 20% EPS is coming from. It's coming from tax cuts, and so that justifies the higher multiples. And so you can easily then go, okay, well, I'll go out and buy stuff that looks expensive, but the earnings growth carries me, and now it's no longer expensive. I guess at the moment is we're looking at it saying, okay, we think there's going to be downgrades to earnings. We think earnings are roughly holding where they are, so it's pretty hard to see where are you going to get an extra jump in earnings from. So if earnings just sort of hold steady where they are, and maybe you get sort of 5% growth at best in terms of earnings, then you don't want to be paying top dollar for that type of market.
Yep.
Whereas if you're paying top dollar for a market where you can see the growth, then or it's you're in the cycle upswing and all those types of factors, then there's a lot more scope to pay up. When you're looking at markets that are very expensive, and then you're saying, okay, well now the growth looks relatively all baked in already, and there's potential downsides to this growth if you get trade war worsens, or if you get these other factors come through, then that's where that's where you need to be concerned about markets sort of correcting.
And that's why some argue that right now there's a disconnect between bond yields and equity prices.
Yep.
It's not a good news disinflation story. It's inflation falling away as these risks bite. That's why bonds are bid so strongly.
Yep.
And so the rise of equity prices, is high risk in that context. So we added a fourth risk there, which I've become quite concerned about in recent times, which is oil. Oil's basically these days one of the key lines of contagion from global weakness back into the US, because the shale oil story has become so central to US investment growth, and it's become a big oil exporter, and as we know, the production of shale oil takes a lot of high level consistent investments, so it drives a lot of growth in corporate spending, and when the oil market comes out of balance because growth is falling, it's the US that wears that pain most immediately, because the oil price has to fall to knock shale oil out.
But can I just put a little bit more context around that as well?
Sure.
Is that US used to be the opposite. So it used to be when the oil price rose, that was like an interest rate rise in the US. Everyone pays more at the pump, and all of a sudden people spend a little bit less, and you get things slow down. The oil price falls, and you get the opposite. All of a sudden everyone's got $20 more in their pocket every week, and they go out and spend it. So what's happened though with the US, given that shale boom Dave was talking about, is that now you've turned it into a two-factor where yes, the oil price goes up and everyone pays a little bit more at the pump, but all of a sudden there's all these companies out there hiring more people, pumping more oil and spending all this extra capex, and that sort of bounces around the economy in various places that are all strong. And so you get a little bit of an offset, and then vice versa. When prices fall, you get consumer benefit, but the capex sort of fades away.
Yep.
And so that's where so oil's in the US, it's not like it was 10 years ago or 20 years ago. It's a very different dynamic in terms of how the oil price actually affects the US in terms of their growth.
Absolutely right. And at the moment we're in a building oil glut. And obviously surrounding that we have those first three risks, with the possibility of demand growth falling even more, and so there's a distinct possibility. Basically oil is very seasonal across the year, and as you come into the second half, especially towards the end of the year, the oil market loosens a lot.
Okay.
And so there's a possibility of a pretty decent oil glut going into the end of the year, or like just intrinsically without these extra shocks. And when we've seen that in the past couple of years, the oil price has crashed. And what that does is immediately causes investment spreads in the US junk bond market, which is where the shales get a lot of their investment money. They all blow out. In fact, in other words, debt gets a lot more expensive for them, and that starts to really shake up US markets. Including the equity market,
right? Yep.
And that tips us into the number 5 risk there, which is US corporate debt, which is extremely high at the moment, in part because of all these earlier drivers for cheap debt, low inflation, low growth, etc. And so you can have spreads blow out for corporate debt if you get those first 4 or some combination of those 4 transpire very quickly.
But it's also a risk in its own right, in that corporate debt is extended, and most of it's because the interest rates are so low. So in terms of payments that are at risk, it's not as much. You don't have to worry as much about that. And we're not expecting any rapid rises in interest rates, and partly because debt is so high that the central banks use interest rates to manage inflation, and if they raise rates too quickly, then in Australia you're going to smash all your households are hugely geared. In the US they're still pretty geared, but their corporates are really geared, so you'll start sending companies broke. So we don't expect the rates to go up that quickly in terms of that side.
Yep.
But there's always a risk of an accident, and the problem with the corporate debt is you could have a high profile blow up.
Yep.
GE is a huge name, and they're flirting with going with lots of debt out there, and they're flirting with becoming sub-investment grade and all these issues. Not saying they're the one that's going to be the domino, but there might be a
large company,
just a large company somewhere.
Yep.
That's right, or maybe not Lehman. Yeah. That's Lehman Brothers is an extreme exchange, but an Enron type case or something like that, where a large company, and whether it's fraud or whether it's mismanagement or whatever it is, it all of a sudden blows up this huge issue in the debt market.
Yep.
And you generally tend to find when that happens, everyone all of a sudden goes, oh, that's right, companies can go broke.
Yep.
And there's actually some sort of very, very low rated company debt that in the Europe that's actually trading at 0 or negative yields.
Wow. Yep.
And so you get a decent sized company that's well advertised around the world, and all of a sudden the premium people are going to demand will jump by at least a couple of percent, and that's going to put the brakes on these, and could start causing other issues in that existing ones are like, yes, I've refinanced all this stuff at a 3% interest rate, and it's it's a massive amount of debt, but I'm only paying 3%, so I'm fine. And then all of a sudden your debt starts rolling off, and the next jump is a 5%,
yep.
and you're almost doubling your interest payments.
Your cost. Yep.
I can't handle that. Oh no, I've gone broke.
Yep.
Then the next person,
and then contagion
effect.
Yeah. Okay.
So I guess the corporate debt, given it's so high, is not intrinsically a problem until it is. Okay. And so it's almost it's one of those ones you never know when one of those can hit, and maybe you'll sail through and none of those will ever hit, but there won't be any such high profile ones that you'll get concerned. But it's certainly a risk to the whole scenario as well, and saying if I'm going to invest in a market that is very expensive with low growth, then I'd prefer not to be investing in that market when corporates are already geared to their eyeballs.
Okay.
And so just one more negative factor for.
And the final one here we've got, not so much a risk, looking forward to it, helicopter money.
It's potentially a risk for high value equities in the long run.
Okay. Please explain.
Just put this one in, for more of a structural risk in the long term. Simply because you know if
Do you want to explain helicopter money?
Yeah,
first?
maybe just give some examples of helicopter money.
Sure. Well, I mean, it's just printing money by the central bank, basically to pay for, some kind of public either investment or consumption, or for that matter, giving it to the public, either a universal basic income or something of that nature, or a cash giveaway, whatever it is. But it's basically creating money out of nothing, and giving it to someone to spend. Yeah,
and why we've got it on the list is because why we look at helicopter money as being a bit of a game changer is because we've had this major financial crisis, and we've had 10 years of everyone trying to fix things by lowering interest rates and quantitative easing.
Debasing the currency.
Basically done exactly what Japan did for 20-something years. Are we 25 yet? I don't know. It's getting close.
Got to be getting close, yeah.
And getting the same result in every, pretty much in every country, that you get stuck in this debt trap you can't get out of, and the net effect is you need wages inflation, and you need wages growth and wages inflation to get things going. And without some sort of helicopter money, it's hard to see what else is going to be. So maybe there's something else that will cause this, but at the moment we're looking at it going, every central bank is repeating exactly what they did the last time, and the effects are getting less and less every time, and so we're just stuck in this never-ending low-growth environment where you just keep building up debt and lowering interest rates to build up more debt to try and get out of your debt trap, and you're stuck in the same spot. And so what this is saying, well, could there be a structural change? And a structural change could be helicopter money becoming part of the central bank toolkit. It's still some time away. There's a bit of discussion in the US about it from the Democrats, but pretty much there's not much. I don't know, the rest of the world. Maybe there's been. Yeah, I can't think of too many examples elsewhere.
No, I mean,
so there's lots of people from non-mainstream talking about it, and lots of academics who talk about it. But in terms of mainstream, taken by major political parties who have a chance of being in power. There's really little at the moment, but
that's Ben Bernanke. He more or less invented the term helicopter money, I think.
Yes.
Yes. So I mean, there are agents of influence, if you like, who are supportive of it.
Yep.
But no, it's still a long way from mainstream policy.
Yeah. Okay, so we have this potential structural change, I guess you'd call it, in terms of the way the world, in terms of the way the monetary system works, and that's where, and that's why we're sort of thrown up on the risk of saying, well, what's the risk if you do start getting this? If helicopter money comes, what's the risk to earnings and growth? And that's why I throw back to David in terms of that.
Well, it's just the inverse of what we've been discussing today, which is basically if you do manage to generate some inflation, then your your equity risk premium will start to fall, and so some of those equity valuation measures will get crimped and start to weigh on possible returns. It's a new regime in which to consider your asset allocation, basically.
Yep.
Yeah, okay. Your other major risk is that corporate margins are really high at the moment, and a lot of the reason why corporate margins are high is because we haven't seen wage growth.
I was just going to say, yeah. So you touched on the wage growth being sort of one of the many myriad of solutions to driving or pushing up demand, and obviously that's. For mine, we've seen a little bit of that in Australia, and I'm sure it has negligible effect on equities, but in the push to rise, say, the minimum wage, and then you're looking at corporate tax cuts and then personal tax cuts as well. So is that the government by way trying to help through some form of regulatory stimulus that isn't helicopter money? Is that sort of an earlier step before you start getting to just parachuting buckets of dough around the joint and just
Yeah, potentially it is. I mean, the issue is, I think. For Australia, it's probably more about saying, let's take a temporary, as we like to do, let's take a temporary commodity boom and turn that into a permanent tax cut.
Yep.
I think there's, and there are elements in terms of Australia, in terms of, there's a natural, and a lot of other countries have this similar thing where you have your brackets, your tax brackets, and so you start taking more and more of everyone's wages as just through inflation. Yep. Everyone starts ending up in higher tax brackets. And so every now and again you get to go, hey, everyone, there's a tax cut. And so rather than sort of saying, let's rather incorporating that into your system is actually not a bad feature to have, because it means you can say, okay, well, I'm gradually going to rise taxes until I need them, and then I'm going to send them back to people and sort of give a bit of stimulus. But in terms of you don't want to ruin your tax base. You don't want to say, okay, well, all of a sudden everyone, let's not pay any taxes, and we'll all have this great, there's all this huge great spending spree, and then all of a sudden you turn around and go, well, actually that's right, we do need to pay for hospitals and schools and all that type of stuff. Let's throw all these taxes on.
Yep.
And at that stage you smash you smash demand.
Yep.
And so and if you bounce around with those types of things too much, raise tax, lower tax, raise tax, lower tax, then you tend to find consumers then start saying, well, even when you lower taxes, I'm not going to spend it because you're just going to raise it again. So
yep.
I'll just save that for a rainy day. Whereas if you can sort of so I guess in terms of that, we would look upon cutting taxes to get there as not being as useful as just central banks saying, okay, well, here's this one-off batch of cash that we're either going to, forgive a bunch of government debt, or we're going to give a bunch of money to government to go out and spend on infrastructure projects. That's that's going to be more of a one-off nature than a
okay. All right, very good.
Or lots of one-offs for 10 years.
Yeah, right. Okay.
Yeah.
I mean, I guess the key is you're not pulling forward demand. Whereas if you're using debt, you almost inevitably are.
Yeah, okay.
You've got to pay the piper before long.
Yep. And you're counting on inflation to hopefully make it cheaper at the other end when you need to pay it off.
Well, in the end, the governments need to start generating inflation somehow. Because what tends to happen if you don't generate inflation is that the rich people stay rich and the poor people stay poor, and then the poor people get very upset about staying poor and not being able to become rich, and next thing you have revolutions or some serious structural change. You start voting in some weird and wonderful people with strange haircuts in Anglo countries on both sides of the Atlantic.
The coal mines.
That's right. So just because you want something to change,
right.
that, not because people have thought this through and thought, yes, this person, the person that promises everything, they tend to say, well,
better than nothing.
I know what's happening at the moment doesn't work, so I'll vote for somebody who's promising change. And so I think that's helicopter money has got a number of issues in terms of that wages growth part about saying, well, all of a sudden companies might find while revenues might be growing, all of a sudden your earnings aren't growing, or they're possibly even going backwards if you have to start giving it back to employees in the higher form of higher wages, which is good for the economy, but may not be as good for some stocks in the market.
All right, very good. Well, on that note, we'll finish up and jump across into next week's topic. So we've invited along, we're going to be having a chat to a property expert based in Sydney. So for those that have been following us, Catherine Cashmore often comes in and gives us a bit of a snapshot on the Melbourne property market. And we have someone of similar ilk in Susan Farquhar joining us for a chat. And so we'll be putting that out at same pat time, same bat channel, 12:30 p.m. On the Nucleus Wealth live webinar page. Really look forward to hearing what's happening up in Sydney and what the prospects are going forward. And on that note, well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you with the next one. Cheers.